morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks extend a global sell-off led by tech. A mixed U.S. jobs report adds to fears the Fed is behind the curve on rate cuts. China struggles to slay the deflation dragon as August consumer prices rise less than expected. Weak demand is damaging the chances of hitting Beijing's growth target. Plus, smartphone rivalry. Huawei is set to ramp up the pressure on Apple in China, launching a tri-fold phone just hours after the debut of the iPhone 16. Well, it's just gone 8 a.m. across the Emirates, but I'm not in the Emirates today. I'm in Saudi Arabia at 7 a.m. over here in Riyadh. Good to have you with us. I'm Joanna Versace, and let's get you straight to the show because Friday was quite a day for markets. Lots of anticipation going into that NFP print, and what we did get is kind of a mixed number. We're going to talk more about that on the show. The headline, slightly lower than expectations. The unemployment rate, not as bad as feared. So if you had walked in not knowing if the Fed were going to cut 25 or 50 in September, you haven't come out the other side with more certainty either way. The reaction in markets, bit of a sell-off we had for Wall Street. S&P and NASDAQ pulling back by the course of the day. S&P down 1.7% on Friday. NASDAQ down 2.5% by the end of the day. The worst weekly return for the NASDAQ since 2022. And remember, all eyes on NVIDIA. NVIDIA ended the week down 12% as well. The handover today, as you can see, as we head in to the European session, is slightly more positive. We are seeing some stabilization, but overnight in Asia, the Asia-Pacific indices are seeing a big pullback as well. We're going to talk more about that shortly with my colleague David Inglis. And then oil. Again, a major week for oil last week. A lot of decisions coming through. OPEC Plus deciding to push backwards their decision to start putting extra oil barrels into the market by another 2 months. And while we saw a little bit of stabilization, the outlook certainly does appear to be quite dim. We're paying close attention to some of the analyst reports coming through over the course of this weekend. Morgan Stanley, the latest to throw in the towel on some of their more bullish forecasts, now estimating that oil is going to average around $75 in the fourth quarter. So that was that. Let's also just take a look at the terminal chart. This is quite interesting as well, and essentially just tells you about what markets are pricing in terms of those rate cut expectations. And before the speech from the Fed Governor Waller, the market was again quite 50-50. We went up to as high as 70% chance of a 50 basis point cut before Chris Waller started speaking, but then he signaled to the market that he was leaning towards 25 basis points, and now the market is pricing in a 30% chance of a 50 basis point cut come September. So still, it's all up in the air as far as September is concerned. We're talking about the market impact, so let's engage in a bit more discussion about what has been happening in China, because it's not just NFP, David Inglis, it's also some of the weak inflation data coming through from China today, isn't it?
Absolutely, and good Monday morning. Thanks for having me on your show. I mean, if you really think about it, to your point, right? So on one hand, we have the conversation around the U.S. and how weak that economy is starting to look. And, is 25 not enough? Is 50 signaling a bit too much? And then you have China, which is the second biggest economy, not also firing, and we know it on all cylinders. So you have this sort of almost wholesale de-risking of some of the crowded trades in the market, right? So Japan is really at the center of that. Japan has done very, very well. The AI trade has showed up in markets like Korea, like Taiwan and the Asia-Pacific. So in fact, these three markets, to the point of some of the conversations we were having on shows, are really at the center of the sell-off and could see a further 5 to 10% decline. We talked about chips and the crowded trades there, and as you can see, leading declines across the region. On top of that, Samsung Electronics, you have some brokerages, including CLSA, have come out and reduced their price targets on the stock because of the profit outlook. So that's sort of triple whammy or whammy number three. The other one thing we want to point out is to your point there in China. So we also did get some industry data on home sales, some of the monthly indicators from some of the big players like Vanke coming out with, again, a softer set of numbers on top of the inflation pitch, which also came in on the softer side. So put everything together, we have a CSI 300 that is now very close, about 20 points from setting a fresh 5-year low. And I guess just putting everything together on the softer print on the China macro front, one of the best iterations of that is the price of iron ore of late. And what happened in the Asian session on Monday was we dipped past tense, because we're slightly above that right now. We dipped below $90 for the first time in nearly 2 years, underscore Jemana, to your point, this softness we're continuing to see in the Chinese economy. Back to you.
Well, it must be quite the day in Asian equities to get you on our show, David. It's good to have you on Horizons today, David Inglis in Hong Kong. Let's continue the discussion. U.S. hiring fell short of forecasts in August, fueling an ongoing debate over how much the Fed should cut rates, as we were just talking about. Treasury Secretary Janet Yellen says there are no red lights flashing for the financial system.
Overall, I would say for the U.S., the kinds of metrics that we would monitor that would summarize risks, whether it's asset valuations or the degree of leverage, things look good. There are not, I don't see red lights flashing.
Meanwhile, Fed Reserve Governor Christof Rühl says the latest jobs data calls for the central bank to begin cutting rates.
I believe that the balance of risk has shifted toward the employment side of our dual mandate, and that monetary policy needs to adjust accordingly. The current batch of data no longer requires patience. It requires action.
Let's bring in Brett McGonegal, a Capital Link CEO. Great to have you with us, though you're in Dubai and I'm in Riyadh today, but good to have you with us on our show. Anyway, let's just start with your take on those jobs figures that came through on Friday, because as I highlighted early on in the show, if you had gone in expecting to get more clarity on what the Fed were going to do in September, it doesn't feel like we're coming out the other side with more certainty. There was something in the numbers for everybody.
Yeah, I mean, listen, the numbers continue to be challenging for the Fed that's boxed themselves into a corner, and really their only outcome is to perfectly thread a needle. They've waited way too long. They're behind the curve. The worst case scenario was that you had no movement in July, you had a sell-off in August, and then all of a sudden you're into the political mode with the elections coming. And I think nobody wants the Fed to be stealing airwaves in September ahead of a November election. But once again, they've managed to steal the headline. And the headline isn't that they know where they're going. The headline isn't that they're putting certainty in the market. The headline is the exact opposite. It's uncertain again. Could it be 50? Is there going to be knee-jerk reaction? None of this stuff is positive for a market that can't really read the data that correctly.
Okay, I'm going to push back on that. You say it's not positive for markets, and yet markets are very close to all-time highs. You have inflation heading back towards their price stability target. Almost, they feel like they have certainty that inflation is getting back to 2%. The unemployment rate is still sitting around 4.2%. And you have the Treasury Secretary, Janet Yellen, saying she envisages a U.S. soft landing. There aren't a lot of official signs out there that the U.S. is actually heading into a hard landing, or that the Fed has engineered a hard landing. So many people would say that actually the Fed have done their job.
Yeah, so I think I agree with your first part of it. The market actually is okay right here. But let's not forget the masking factor of 7 to 10 stocks in the U.S. market. There's another market that exists way outside of these 7 names, and they're not performing well. The base is not widening on near all-time highs. Yes, we're down slightly from all-time highs, but really if you take those names out of it, and NVIDIA is now giving you some sort of a look through to the future that if one of these guys stumbles, what happens next? I just don't understand why the Fed is so far behind every move. They've had so many opportunities to read the tea leaves. The economy is not performing well. You look at credit card balances, you look at food pricing, you look at unemployment, and then you put in the big question mark, which is really the biggest question mark in the world right now, is what happens come November 5th. So we have 6 or 7 weeks of jawboning that's going to be largely political. It's going to move the markets quite substantially. And what my real criticism of the Fed is they're supposed to be the steady hand on the wheel. They're supposed to set the course of action. They're supposed to move to the background. We've seen more Fed governors and more Yellen and more Powell on TV than the CEOs of the major companies that are reading the rally. That's not what they're there for.
Well, we're heading into a blackout period now, so you'll get a bit of respite from listening to some of those central bank governors. But let me ask you this. If the Fed do actually go for that 50 basis point cut in September, do you think the market will read it as political?
I think they'll read it as political, but I think that will be a secondary factor to the risk factor of why 50 out of the blocks, right? We've had plenty of time. This thing has been telegraphed for a long period of time. Why get yourself in a position where you can't just gradually kick off the cycle of reducing rates, right? Let's go back to that old idea I said, the steady hand on the wheel. If you're going to change monetary policy, and the real reason to do it is because you're responding to the economy, then you kind of want it to be a soft headline. You want it just to be part of the action of you're engaging in a new monetary policy. There's been shifts. This is a pivot. We're moving. We're going to be on we're going to be an extended period of time lowering rates given the economies around the world. Why start with 50? 50 has never been a number that gets people to say, it's not a gradual number. It's kind of a knee jerk. And then you get into, you said, the whole political wrangling of why is this happening now? Is this a last-ditch effort from the Democrats to kind of spur the economy or get the economy to be positive ahead of the electorates going to the polls? None of this stuff reads steady. None of it reads soft. I think what you would rather have is 25 basis points and a huge amount of dovish language coming out of the governors, and start to kick off the process that this is happening, and it's going to be measured, and it's going to be understandable, and we're going to set clear targets, and people can follow it.
Yeah, I feel like they are beginning to go in that direction, though. But also, given we've talked so much about the big political events happening in November with those U.S. elections, come November the 6th, what is going to be the bigger driver for markets? Is it going to be the next U.S. president, or is it still going to be the Fed in the driving seats?
Well, we have this great opportunity of the election on the 5th, the Fed on the 6th and the 7th. It sounds like Pennsylvania's been talking a bunch over the past few days that they probably won't even have the votes in on the 5th. So it seems to be the big swing state. Pennsylvania most likely could control the whole election. We may not even have the votes in. We're going to kick into Powell going on the air a day and a half later. I just don't understand why we want to be in that position. So the election is going to either be something that goes off in some sort of a whimper. I'll give that a 1% chance. The 99% chance is it becomes highly controversial. The headlines are going to be about, either how Trump has won or how he's not won and reacted to it. The Fed will play a back seat there. So maybe they get the blessing of being under the radar for the first time and not grabbing that headline. But people are still going to be looking to them. And I don't think we're going to have enough clarity for them to give a knockout punch. They're going to continue to have to be dovish. They're going to continue to play from behind. And then the next round of questions is, what happens next? You have a new administration coming in. No one's going to be able to gauge what that looks like in any orderly fashion. Yeah. So you're going to have a lot of volatility from now until January.
Yeah, let's see, especially with former U.S. President Donald Trump floating the potential of, let's say, 100% tariffs, putting that one out there as well. Something to think about for markets. Brett McGonegal, Capital Link CEO, always a pleasure to chat to you. Right, coming up, Morgan Stanley has cut its Brent crude forecast for the second time in a matter of weeks. We'll take a look at the oil market next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Rossetti in Riyadh today. Oil is edging higher from its lowest close since 2021. The gain comes as deep losses pushed futures close to levels regarded as oversold. Morgan Stanley has cut its Brent crude price forecast for the second time in a matter of weeks, predicting that the global benchmark will average $75 a barrel in the fourth quarter. Traders will be closely watching market analysis from OPEC and the IEA, which will be released in the coming day. Joining me now is Christof Rühl, Senior Research Scholar at Columbia University Center on Global Energy Policy, who joins me from London today. So good early morning to you, Christof. Watching the price action in oil the last couple of weeks, it feels like the setup is so bearish. It's been very difficult for oil to get a sustained bid. What do you think is going on?
Good morning. Yes, it came rather suddenly. I think what is going on, what we are witnessing, is a shift in expectations, which is pretty profound, pretty sudden, and especially pretty widely shared. For the last few months, everyone looking at oil prices was sort of assuming, and it was true, that oil prices were bouncing around somewhere between 80 and 85, 86, sometimes 87 levels. And the bounces were driven by clearly depictable geopolitical events in Gaza, attacks on refineries in Ukraine or Russia, and so on. Now suddenly this downward drift. What it means is that expectations have become clear that for 2025, the market now expects, and rightly so, I think, an oversupply. There was massive production in non-OPEC countries and demand not as strong. And this will probably start at the fourth quarter of 2024. And so that has led to this shift, which might have a little bit of an overshoot, but we should not expect prices to come back sizably about 80 in the next few months.
Yeah, it does feel like many analysts out there are also throwing in the towel as well. OPEC Plus took a decision last week to extend the timing of beginning to taper their voluntary cuts. It's quite a wordy statement to put together, but essentially they're going to start putting extra barrels to market, in theory, beginning of December instead of beginning of October. Now, we did see some stabilization come through after that announcement, but I do wonder to what extent, looking ahead, OPEC Plus are still going to be in the driving seat for determining the supply that hits the market. It seems to me that less and less, or perhaps more and more, we're talking about the extra supply coming through from the likes of US, Brazil, Guyana, and that because of that, it makes every single decision that's coming through from OPEC Plus perhaps less impactful.
I think that is correct. And I think OPEC Plus is now in a very difficult position. They have what they always tend to have, a credibility problem, because these cuts now initially were small ones driven by small producers. And every one of these producers will now make the back of the envelope calculation. If I cut some volume and prices stay a little higher, is that worth my while or not? Or am I better off to produce more with prices maybe a little tiny bit lower for my revenues? And so it's very hard to herd this bunch of cats in a consistent way in a difficult market situation like that. But much more importantly, OPEC Plus now has removed more than 5.5 million barrels off the market. And all of that goes at the expense of market share because of the very strong supply growth outside OPEC Plus, in Guyana and in particular in the US still, with flexible shale production. And so what happens, you continue to lose market share and your pricing power continues to erode. In many ways, this is a harbinger of bigger things to come. Should the oil market ever peak or stabilize or plateau, then it will be very hard for a producer association like OPEC Plus to sustain its market power.
Yeah, interesting. Let me ask you a medium-term question. Remember back in COVID, out of COVID, everyone thought that because of that and because of the renewed focus on energy security, that there would be a huge shift towards electric vehicles and that would accelerate the green transition. What we found out in the last 6 to 9 months is that many automakers are citing weakness of sales in electric vehicles. It hasn't really turned out the way that they imagined, and because of that, they're taking lots of write-downs in that space. How does that translate to this peak oil demand theory? And because of what we're seeing in, say, the speed of the rollouts in EVs, do we have to push back that timing of peak oil demand a couple of years now?
Probably not. There's a very interesting statistical fact in oil markets, which is there's an enormous degree of regularity with which the efficiency with which we use oil, the efficiency with which we drive, which we produce petrochemical things, everything oil is used to improves year after year by in almost a straight line, by 1.5%, 2%. And so, and if you just continue this trend, which exists for 30, 40 years, then oil markets would peak in this decade without even the help of a sizable share of EVs. Now, EVs have their own problems. Not last of them is that they have so few moving parts that they can be produced in countries without a very specialized, experienced workforce, such as Asian countries, such as China, of course, just like the digital camera suddenly was produced in Asia and came, and the automated reflex cameras in Europe were out of business. That threatens to happen to the car industry now in Europe and in the US, and we all see the political consequences already in the form of tariffs and so on.
Yeah.
So the EV process might slow down, not only because of consumer preferences, but also because of producer protection in the so-called developing world. But independently of that, the way we use oil is getting more and more efficient, and that just limits what we call the oil intensity. The amount of oil you need per unit of global GDP goes down every year. And if you continue that line, we will peak in that decade. The IEA has it right there for once.
Interesting. Okay, well, that's a good place to leave it. I'd love to pick up the conversation with you at some point in the future. Christof Rühl, Senior Research Scholar at Columbia University Center on Global Energy Policy. Thank you so much for waking up early for us this morning. All right, still ahead, we discuss the private banking boom in the Middle East as the ultra-wealthy flock to the region. More on that in our Mideast Money segment later in the show. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersecci in Riyadh. A gunman has killed 3 Israelis at a terminal on Jordan's border with the West Bank, the first such incident since the war in Gaza began. Israel's army says the gunman accessed a bridge crossing from the Jordanian side in a truck and fired shots before he was killed. The victims were identified as forklift operators over the age of 50. Israel closed the crossing while checking the truck for explosives. Venezuelan opposition leader Edmundo González has been granted political asylum in Spain after fleeing his homeland to avoid arrest. It comes a month after the opposition presented voting records they say prove González won the July 28 presidential election. But Venezuelan authorities said Nicolas Maduro was re-elected to a 3rd term and ordered the opposition candidate's arrest. And Republican presidential nominee Donald Trump leads Democratic contender Kamala Harris by 1 percentage point in a poll taken late last week. The New York Times Siena College survey has Trump at 48% to 47% for the vice president. Meanwhile, Trump says countries that trade with currencies other than the dollar will not do business with the U.S. if he wins office again and would face 100% tariffs on their goods. Well, quick look at futures before we head to the break. What we are seeing is a little bit of green for these equity futures after the big pullback that we had on Friday. Even in Europe, we're seeing looking towards a trade in the green in a couple of hours. Be right back. Good morning, everybody. This is Horizons Middle East and Africa. Our top stories this morning. Asian stocks extend a global sell-off led by tech. A mixed U.S. jobs report adds to fears the Fed is behind the curve on rate cuts. China struggles to slay the deflation dragon as August consumer prices rise less than expected. Weak demand is damaging the chances of hitting Beijing's growth target. Plus, a smartphone rivalry. Huawei is set to ramp up the pressure on Apple in China, launching a tri-fold phone just hours after the debut of the iPhone 16. Well, it's just gone 8:30 a.m. across the Emirates. It is 7:30 here in Saudi Arabia. I'm Joanna Bersecci in Riyadh, getting a check on how markets have reacted since that NFP print came in on Friday. Pretty much something in it for everyone, as we were just discussing at the top of the show. The headline numbers slower than expectations, unemployment rate slightly better than expectations. Markets still unsure whether the Fed are going to go for 50 or not. But what we did see is a big pullback for equities. It was actually the worst week for the S&P since the regional banking crisis of March 2023. So we closed down 1.7% weaker on the day on Friday. NASDAQ down 2.5% weaker on Friday. Also the worst weekly return for the NASDAQ since 2022. A lot of focus on NVIDIA stock, which also ended the week down 12%. But today, some stabilization. We spoke about it. Green on the board for S&P and NASDAQ. But the handover from Asia has not been pretty. Asia Pacific Equities down 1.4%. Another big pullback in the Nikkei as well, as risk-off sentiment hit some of the key tech stocks in the Asian session too. Also keeping a close eye on some of the inflation data that's come through from China, disappointing to the downside too, just adding to some of those economic woes and the signals coming through from there. And then Brent, we are seeing a bit of an uptick this morning, trading just shy of $72 now, about 1.1% firmer on the session. But of course, it was quite a weak for the energy complex, with all of these commodities pulling back around 8% over the course of the week. WTI and Brent down about 8% in the course of the week last week. Now, switching over, I just want to draw your attention to what the market is pricing in, namely because we had some commentary from one of the Fed officials, Chris Waller, just after that NFP report came through. And so before he spoke, the market was pricing in around 70% probability of a 50 basis point cut. After he spoke, signaling that they're leaning more towards 25, we're now back to 30%. It just tells you how much power one individual has in terms of driving market expectations as we head into the Fed blackout period. I also just want to draw your attention to another chart that we're watching this morning as well in the context of oil, because we've been tracking the price of oil very closely. And here you can see that traders have started to trim some of their long positions. So the net long position, if you take that difference between the orange bar and the blue bar, has been trending lower, the lowest we've seen since February, and more as a reflection that the investor community is coming around to the view that there isn't perhaps a lot of upside to being long oil at this juncture, and that is weighing on the commodity complex as well. So something to watch out for from a technical perspective. Now, speaking of energy and the fact that I'm in Saudi, Bloomberg has learned that Saudi Aramco, ADNOC, and commodities trader Trafigura are amongst the suitors competing to buy Shell's service stations in South Africa. Now, Shell may seek to raise nearly $1 billion from the sale of its downstream unit, which includes a network of 600 service stations across the country. So for more on this, let's bring in Bloomberg's Middle East energy reporter, Anthony DePaula in Dubai, and Bloomberg's Africa senior reporter, Loni Prinsloo. Loni, I'm just going to start with you. It feels like we've seen lots of deals in the South African petro industry in the last few years. Can you just tell us more about some of those deals that are taking place in Africa's biggest economy, in this case, of course, South Africa?
Sure, Jemona. So I think most recently we saw also a few big service stations going through the engine deal. There was some Middle Eastern interest there, but in the end, Vitol picked up those engine service stations. And then we had Shell also selling their refinery quite recently to the South African Central Energy Fund, which went more for fuel security reasons in South Africa. But with the most recent deal with Shell selling their service stations, we are seeing quite a lot of interest. We're seeing the traders again with Trafigura, but we're also seeing Aramco, as you said, and Abu Dhabi oil companies. So yes, so there's about 640 service stations, and I think they want to raise about $1 billion with this deal.
Well, let's switch over to Anthony. Anthony, you and I have had many conversations about Aramco and ADNOC's expansion ambitions. It seems like lots of them, Aramco, ADNOC, Trafigura, are all interested in acquiring Shell's assets in South Africa. Why? Why are they interested in these specific retail assets, to your mind?
Yeah, and we've also got Oman's state oil company trader, OQT, is in there as well as some smaller South African companies that are looking at those assets. So, I mean, these kind of assets are really interesting for traders because, of course, South Africa is a huge market, lots of stations there, lots of retail demand. It gives these oil companies, which already have a lot of upstream oil, it gives them an outlet for that crude. So they can supply oil into there, they can supply products in there. Saudi Aramco and ADNOC, which are the biggest government-owned energy companies in their respective countries, they are kind of taking a beat from those big oil majors like Shell and also like those traders, Trafigura, you mentioned, Vitol, which bought the engine stake that Loni had mentioned. They're taking a cue from them in terms of trying to get into this kind of retail business because it gives them a chance to expand their trading operations. They've opened trading where they want to have the ability to buy and sell refined products like diesel, gasoline, as well as crude. So buying these assets gives them that demand, that capture demand that they can go in and supply to and increase those businesses, Jumana.
Yeah. Loni, let me just turn to you and just ask specifically about what interest, I mean, Anthony just encapsulated some of the interest that's coming through from the Middle East in acquiring those assets. But broadly speaking, what other interest is there coming through, again, specifically to some of these assets in South Africa?
So more broadly speaking, in terms of the South African deal space at the moment, it has turned quite a bit more lively after its elections, the country's elections in May, when it formed the Government of National Unity. So since then, you know, covering deals, we have seen, interestingly enough, a lot of Middle Eastern interest. We've seen currently, there's some talks between a big Saudi company and one of South Africa's biggest logistics firms. We're seeing the Shell deal. So just a bit more lively in general. When we talk specifically the Shell assets, of course, South Africa is also interested due to security, sort of fuel security reasons. So the Central Energy Fund looking there, and South Africa's Sasol also looking to pick up those assets.
Yeah. Well, we're going to keep a close eye on what pans out there. Certainly a lot of interest in these assets. Thanks to both of you for bringing us the reports and the latest on what could happen there. All right, moving on. That was Bloomberg's Middle East energy reporter Anthony De Paula in Dubai and Bloomberg's Africa senior reporter Loni in Johannesburg. Now, U.S. Treasury Secretary Janet Yellen says she would welcome a visit to the U.S. by her Chinese counterpart, while she's open to another visit of her own to China. Speaking to Bloomberg in Texas, Yellen underscored the importance of stable ties between Beijing and Washington.
I have seen this sort of diplomatic initiative, both with China and with other countries, as really critical, because we need to work together collaboratively to solve every global problem that we face, from climate change to Russia's aggression to issues that we have with China. And during the previous administration, I'm sorry to say, our alliances frayed, and, you know, it was America first, and that should really never be America alone. And it was necessary to rebuild alliances to work with allies around the world. And that's been a broad effort. And I think we really have succeeded. And perhaps we'll talk about this, but when Russia attacked Ukraine, we had an alliance that came together in a matter of a day or two to strongly counter what Russia was doing. We've stayed together, and we've worked together to address, and this is a broad effort, G20 or larger, to address climate change and problems afflicting poor countries around the world, to address pandemics. We created a pandemic fund, knowing there'll probably be another pandemic, unfortunately, and we need to be better prepared than we were for COVID. So on many different fronts, we've tried to rebuild alliances. And with respect to China, relations had really deteriorated during the pandemic. And we went for a period of close to 2 years without any meaningful senior level contact between U.S. and Chinese. And that was really a very dangerous state of affairs. President Biden met with President Xi in Bali. I was at that meeting, and they agreed that it was important to reestablish relationships. And that means having honest conversations about the things that we're concerned about. It could be, of course, for the defense and foreign policy side, it's things like Taiwan and the South China Sea. For us, it's some of the tools that we think constitute unfair competition or macroeconomic policies that China's following that we see as having negative impacts on the United States and other countries. These are things we need to discuss honestly. So we try to reestablish relationships. Before I went to China—
Do you foresee going back there as Treasury Secretary? Do you need to go back there?
I certainly may go back there. I, would welcome a visit by my Chinese counterpart.
U.S. Treasury Secretary Janet Yellen with Bloomberg's David Gura there. Well, also coming up, we're going to discuss the private banking boom in the Middle East as the ultra-wealthy flock to the region. More on that in our Mideast Money segment. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versecci in Riyadh today. Now let's turn to the Middle East, which is seeing a private banking boom. JPMorgan is the latest to establish a team in Dubai to tap the wealth surge. The firm has recently transferred 2 bankers from Geneva and London. That says more millionaires are expected to move to the UAE than anywhere else in the world this year, according to Henley Partners. So let's bring in Philippe Amarante, Henley Partners Middle East Managing Partner, who joins me now from Dubai. Good morning. Great to have you with us. So we've been tracking and putting together these stories on how many banks are opening up private wealth management divisions here in the Middle East to capture some of the new money that's coming in, presumably because they are anticipating more opportunities in that space. Does the data back that up?
Yes, good morning. Indeed, the data backs that up. So what we see are 2 things. Number one, there's more and more private wealth generated around the world. And, quite often this private wealth is generated in lesser developed markets. Now, these people accumulating their private wealth would like to access the so-called developed markets or new opportunities. So it's all about, I guess, accessibility. And then on the other side, what we see is that more and more governments, more and more countries are actually in competition to attract and retain these individuals because there's a lot of economic stimulation, there's job creation attached to it, right? So the response of the private banks coming particularly to the Middle East and here, UAE, is just a response to those millionaires on the move.
Yeah, and those millionaires on the move, it is relatively easier for the wealthy to move their money around. How much of a draw are government incentives in this space?
So I would say that if you take the UAE as an example, obviously the pro-business sentiment, the business agility, the entire sort of healthy approach to necessary red tape obviously helps. If you compare that, let's say, with Europe, where you have a little bit the opposite, these high net worth individuals, these business leaders, job creators, business owners, they like to operate in markets where they're treated as partners, where it's about collaboration. And I think the UAE has done a fantastic job over the past years to provide that sort of ecosystem. If you look into the Agenda D33 or Abu Dhabi's Vision 2030, that really resonates very well with these individuals.
Do you see positive spillovers into the country's economy, given the influx of so many wealthy from overseas? Is it actually having multiplier effects as far as these countries are concerned?
Certainly it does, and quite substantial, actually. So again, looking in Dubai, which is I guess very well branded with its asset class of luxury real estate. That resonates well with these people. They come here, they purchase homes, multiple homes. They help to further grow that sector, which is very important. You also see that people maybe start doing certain business activities, and these business activities can actually continue to grow. And you see these people also engaging in IPO activities and stock market activities. So there is a very substantiated economic stimulation of these people coming here and making it, their second home, and from here as a base continue to further have commercial activities.
Yeah, but you're also seeing more and more banks get involved in the space. There's a lot of competition. We just had a board up of some of the banks that are making big pushes in terms of their wealth management units over here. And of course, it's not just wealth management. It comes with the whole other suite of services as well. What can banks do to stand out in what is becoming a very competitive arena?
Yeah, I think there's maybe a couple of things attached to that equation. First of all, you also look into the transfer of wealth across new generations, right? Which is something that happens around the world, and banks have been and getting ready for that further. You have digitization, which is, I think, a very important aspect in wealth management. Again, the UAE providing here some interesting legislation that is appealing. And I think there's, maybe also there has been an absence of the modern, innovative wealth management instruments, in absence of these millionaires being here over the past decades. Now that is changing, hence why the banks are getting ready to tap into that market and provide the services that these individuals are looking for.
Yeah, we were speaking to the chairman of Bin Rati a few weeks ago. Obviously, they're a luxury property developer over here in Dubai, and he was super constructive about the outlook for the region. I wonder to what extent the outlook for real estate is linked to the sheer number of wealthy millionaires and wealthy individuals moving to the UAE.
Yeah, I think it's quite an extraordinary story where maybe, the theory of economy doesn't apply anymore. What is incredible for the UAE as an advantage is that actually the supply to some extent is limitless, right? So you have these incredible developers continuing to provide ultra premium real estate assets on the market. Then you have a very pro-business, pro-migration sentiment given from the government. Then you have these millionaires looking for safe havens, looking for markets where they can operate and live safely. Let's not forget, wealth preservation is maybe the first and foremost objective these people have. So it all comes together as a perfect sort of equation. And that is, I would say, maybe the attraction or the key instrument of attraction and retention for the UAE.
Yeah, certainly appears to be the case. A bit of a halo effect going on there. Philippe Amarante, Henley Partners Middle East Managing Partner, thank you so much for joining us on our show today. Well, for more of these stories looking into the intersection of wealth and power in the region, sign up for our Mideast Money newsletter on Bloomberg.com. It's on your screen right now. You can subscribe at Bloomberg.com/newsletters. And coming up, tech fanatics are eagerly awaiting the latest devices from Apple and Huawei, as both firms are set to unveil new models later today. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Shimona Bersachi in Riyadh. Apple is set to unveil its latest range of iPhones later on Monday, including built-in AI features for the first time. And just hours later, Chinese tech giant Huawei will also launch a new device, but possibly with a foldable design. So for more, let's bring in our tech reporter, Annabelle Jewelers. Annabelle, always good to talk to you. First, let's just start with Apple. It's a big event. There's a lot of hype around their new AI-enabled iPhone. Tell us more.
Yeah, a lot of hype. What does it boil down to in terms of the substance? And this is where we're going to have a few question marks, perhaps, because there had been perhaps promise or expectations earlier this year that the new Apple devices will kick off an upgrade super cycle, but that doesn't seem to be the case. So we're going to get a new lineup being debuted later. So you've got the base model, Plus, Pro, Pro Max. And in terms of the changes you can expect from the 15 to the 16, it's really just very incremental. So the actual device look should stay the same. Some of the versions might have a slightly bigger screen. You might see enhanced camera capabilities. You might see the so-called action button, which was introduced last year at the top-end models, then made more standardized. So that's sort of a feature that replaced the mute switch. Won't get into too many details there, but just suffice to say, it's as I said, incremental, small changes. Yes, that focus on the software side as well, because earlier this year we had Apple Intelligence being unveiled. That won't be fully integrated across all of the lineup. So again, it's sort of that vision that was laid out earlier this year. We sort of fall short of that.
Yeah, let's see how the market reacts to that event. Given what you say, it's probably going to be just incremental changes. But it's not just Apple today. There's some focus on Huawei as well. They're holding their own device event just a couple of hours after Apple. What's the focus over there?
Yeah, so this is quite an interesting one. So yes, the timing of it just hours after Apple from Huawei is definitely not by mistake. It tells us that they're planning to go head-to-head with yet another device. So this here is some vision that was teased on Weibo. That's sort of like China's answer to Google earlier this year. But what we are expecting is a trifold device. So we're sort of used to seeing those bifold devices. This one is trifold here, so 3 different points. What it means is that you can fit an even larger smartphone, even larger tablet size onto the smartphone size instead, to get more screen space, essentially. That's sort of the expectation from Huawei in terms of the device. Actually, the event will also be headlined by the company's chips division. So, of course, waiting for any sort of updates. Do we get any sort of semiconductor announcements being made? We have seen Huawei really trying to push ahead and be able to produce a semiconductor that can rival NVIDIA's. Again, haven't seen it just yet, but certainly something that the company is said to be working on very, very urgently.
Yeah, well, we were just playing some of the B-roll there of, well, B-roll is a technical term, but some of the images of that tri-foldable phone, and you can really picture the larger iPad screen or the larger screen before it's folded. So it'll be interesting to see how the market also reacts to that one. Annabelle, thank you so much for bringing it to us. Annabelle Jewelers in Hong Kong with a preview on what to expect from the Apple and Huawei launch events. As we head out, though, for the session, quick look at futures. Things are turning better. So despite the risk-off session for Wall Street, negative handover from Asia, all of these futures are pointing towards the green. That was Horizons Middle East and Africa. I'm Joanna Versace in Riyadh. Stay with us for Daybreak Europe.